If a forward contract is on a commodity as its underlying, it is often the case that there are so-called carry costs involved. These are typically costs such as insurance and storage for commodities such as grain or gold or whatever asset is involved. If these carry costs are not correctly taken into account in determining the price of the forward contract, the no arbitrage principle will be broken and the incorrect forward price will be calculated. The way to correctly include these carry costs is to add them to the spot price at T0 and then to determine the future value of the what we will call the adjusted spot price. The reason that the carry costs are added and not subtracted, which may feel somewhat counterintuitive, are not complicated, but the explanation is best achieved by working through a full arbitrage example, which I think is suitable for a separate video. So for the time being, we're going to proceed using the example in the blue box at the bottom of the screen and simply apply without question for the time being the principle that carry costs should be added. Let us fill in what we know about the situation on the timeline. We have a spot price for the commodity of 12,200 Rand today. We have a risk-free rate of 7.5%. The duration of this particular contract is 8 months, so capital T is 8 months away from T0. We are asked to calculate the forward price of this particular contract given that there are costs of storing the commodity for 8 months of 530 Rand payable in arrears, and therefore that payment is at time capital T. We begin by observing that due to the principle of cash flow additivity, we cannot adjust the 12,200 Rand against that 530 without first taking into account the fact that they are at different points in the timeline. Therefore, we need to bring that 530 Rand back to T0 at the given risk-free rate, which is a calculation of multiplying that 530 Rand by 1/1 plus the decimalized risk-free rate of 7.5% using an exponent of 8/12. And that number is 505 Rand and 5 cents. Because these are carry costs, we apply for the time being without questioning the principle that that is added to the spot price at T0. That means that we have what we will call an adjusted spot price at T0 of 12,705 Rand and 5 cents. And the final step in the equation is to determine the future value of that amount, which is our forward price, and that we determine by multiplying the present value of 12,705.05 by our TBM factor, which is 1.075, once again to the exponent of 8/12, resulting in a correctly calculated no arbitrage price of 13,332 Rand and 62 cents.